you've purchased your whole life insurance, or you're about ready to purchase your participating whole life insurance, but you've got some questions.
You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. Today, we have a few questions you'll get to hear from people that write into our office, and you'll get to hear an overview of the Perpetual Wealth Code. How can it help you keep more of the money that you make?
Those are, we love to get those questions because your questions are what drive this podcast. So feel free to give us a call at 702-660-7000 or shoot us an email at team@life-benefits. That's team@life-benefits.com, and give us your question and we'll address it on the podcast in a future date. So, John, give us a question that was recently sent in to us.
Sure. So some of these questions have specifically to do with the participating whole life insurance policies, because we're using these as tools, kind of as savings tools, to get guarantees, to get guaranteed growth, certainty, and yes, a legacy, a death benefit to go along, protection, along with whatever else we're doing with our finances. So the first question here is, what is backdating and what does it accomplish?
Well, backdating is something that insurance companies allow to, quote unquote, save your age. So let's say that you just turned 30 and you want to backdate. Well, most insurance companies will not allow you to backdate because you are closest to your 30th birthday. But let's say you're 30 years old and 7 months. Well, now, insurance age-wise, you're already 31 because they're looking forward. So to backdate, you could save your age of being 30. Now, what that means is that you would have to pay the premiums for a year, and then your policy anniversary date would literally be in 6 months because you're 30 and a half, and 6 months from that, you're starting. So you would be able to get in 2 premiums in the first year that way. So some people say that jump starts a policy and gets it off the ground better. And it does. It saves your age, and sometimes it's very beneficial. But it's always needs to be considered, what would you do with that money otherwise than buying life insurance with it? Because basically you're buying life insurance on a period of life you've already lived when you backdate.
Yes. So you don't get the protection during that time.
That's correct.
Yeah,
but you do get the compounding growth.
Today, absolutely. You do get the compounding growth, and because life insurance is based on your age and health, those are two of the factors that go into the calculations of the values, you do get that greater compounding growth.
And most insurance companies only allow that for a 6-month period of time.
Sure.
They're not going to let you backdate for 2 years and save age, or a year and save age. It's usually just a 6-month period.
Certainly. Time is important, as you know. So another question that came in is, how does the policy loan interest work?
Policy loan interest is charged by the insurance company because they are loaning you their money, holding your paid-up insurance as collateral. So it's very similar to a HELOC, where the bank holds your house in collateral for a loan that they provide you with other depositors' money. And so typically in a HELOC, what is required is you have to pay the interest on that, so the bank can pay the interest to the other depositors, and they can make a profit on it. There's usually not a rush to pay off a HELOC, and very similar in life insurance, it's the same way. We take a policy loan, we say, but it's actually using our policy as collateral for a loan from the insurance company. And so they need interest, and so the loans are interest only, and there's no rush to pay the principal off. But we have to be careful. You have to be careful when you take a policy loan, and always make sure that you're going to be able to generate more revenue with that loan, capital that you borrowed, than what the interest is that the insurance company is going to charge you. Otherwise, the policy loan may not be in your best interest. Now, insurance companies typically charge interest up front. So it's at the beginning of a loan, whereas banks and other types of loans charge interest in the rear or the end of the loan. So if you have $4,000 of cash value and you want to borrow $4,000, you're not going to be able to, because they're going to withhold interest for the first till your policy anniversary date. So if I take a loan if you take a loan on your policy anniversary, there'll be 12 months of interest that are withheld from the loan that's available, the cash value that's available.
Because most companies charge that interest in advance.
Right.
Sure.
If you take a policy loan 2 months before your anniversary, the insurance company is only going to withhold 2 months of interest, because come your anniversary date of that policy, you are going to be asked to pay interest again for the next 12 months if the loan is still outstanding.
All right. So let's say that I take the loan 2 months before the policy anniversary date, and then I pay another 12 months of interest only 2 months later by the time I get to the policy anniversary. So now you're here at this point. What if you decide to pay off this loan in 6 months? What's going to happen to the other 6 months of interest?
That other 6 months of interest gets recredited back to your line of credit or your cash value policy, something that would be available for you to borrow.
Sure. So you don't have to pay the whole thing back, the whole outstanding loan.
And I hate to say credited back, because it never really left your policy to begin with. It was just held there to protect you from your policy lapsing due to interest being owed.
Good point.
So it just becomes available again. It's more like a line of credit rather than a loan repayment.
Sure.
And that's why I like to refer to this as a HELOC. It's very similar to that. If you pay back part of the HELOC, and it restores what's happening to your line of credit there.
Very good answer. So looking a little bit further, there's people in the industry that promote the fact, or the point that when you pay back the loan, this recredited interest somehow boosts the performance of the policy. So can you speak to that a little bit?
Well, it's been said that figures don't lie, but liars do figure. And that's one of the biggest lies that I was introduced to, and I've seen it introduced to a lot of people, is that if we pay back the interest on a policy loan, it increases our death benefit and our cash availability. That is not true, okay? The interest that is being charged goes to the insurance company.
Sure.
And if we pay back extra interest, so let's say the insurance company is charging you 5% for a policy loan, and you decide to pay it back at 8%, the other 3% is going to be looked at as a premium payment once the interest and principal have reached the point where that loan is paid off. Now, at first, it's just going to look like a loan repayment.
Certainly, a bigger loan repayment than if you were just paying what was required.
Because the insurance company is only going to charge 5%. That's the contract.
Right. And the insurance company, this is an interest-only loan. So as long as you pay the interest, there's no time stipulation on how quickly you can pay it back. So when you send a payment back that's figured at 8%, they're just going to see it as more principal, which means you pay off the loan early, which means by the time you get to the end of the loan, it's going to be paid off early. What do they do with the extra money that you send?
Well, if you keep sending it because you have an amortization, that 8% that you're paying on, then you could very well make the policy become a modified endowment contract if that policy was written in the tight parameters that we like to write policies for clients, because we're already maximizing the cash value that the IRS will allow to appear in a whole life insurance policy. And so this extra 3% on your amortization table doesn't appear on the insurance company's amortization table. And now you're paying extra premium, and that very well could put you over the threshold of the MEC line.
All right. So as you're listening to this, the takeaway then from this is that trying to pay extra money into the policy isn't going to make it perform magically better for you. You might be able to get a little bit extra in, but if the policy is already written well to begin with, there's not much of a point in trying to force that extra money into it.
Right.
Let it sit in a separate side checking account. We call that the money manager account. Let it build up for a future opportunity, whether that's getting more guarantees on it, to purchasing another policy, whether it's maybe an outside opportunity that comes along.
Now, because the modified endowment contract rule is based on the 7 pay period, as the policy matures, there naturally occurs a little wiggle room in what you could pay extra in. And that's important to contact the agent so they can find out from the insurance company exactly how much extra you can put into that policy without it becoming a modified endowment contract. And John, so you know that what we try to do in this office is just to realize that this is going to happen if we're following the Perpetual Wealth Code. And what you can do to avoid this is to start another policy as soon as it's comfortable and affordable, so that extra money that you have on your amortization for an 8% loan that won't fit into your original policy, you can start thinking about maybe buying a policy on your child, or maybe your spouse, or maybe another policy on yourself with that extra cash flow.
And that's usually the most efficient way to expand, because by the time you wait for the insurance company to run the calculations and figure out a very little bit more that you can add to it, it just makes sense to expand your financing system in other ways.
And if we're making money off of using this capital we made a policy loan for in the first place, then there's going to be more income that we need to look at for you to be building the cash reserves in your whole life policy to begin with. And so combined, it's not a difficult thing to imagine or to realize when you get there that the second policy is a very efficient way to keep more money in participating whole life insurance.
There we go. And that brings us to another question then that brings us to kind of an overview of the Perpetual Wealth Code. Why are we using the life insurance rather than just buying term insurance? Because people have heard, buy term, invest the difference. This gentleman writes in, he says, where's the break-even point here on a policy? Because, you can buy term insurance or you can buy the whole life insurance, which is more expensive initially. You have to put more outlay into it, but you start building equity in it. So where is that break-even point?
Well, it takes us back to the 7 pay period in the modified endowment contract, because since 1988, it's very difficult to write a policy that quote unquote breaks even between what you've paid in premium and the guaranteed cash values before year 10. Now, it's impossible to do that without creating a MEC before year 7. Because that's the definition of a MEC, is that you would put more money into a policy in the first 7 years than what it would take to pay that policy up. And if you paid the policy up, you would naturally have more cash value in it than what you paid in premium. So typically, we're seeing that break-even point, if we're looking at all ages and health classifications, and somewhere between year 8 and year 12 would be a well-designed policy. I was looking at a client the other day. He was wanting to know if this would be good for him. He has no dependents. He doesn't need the legacy. He just thought this would be a great way to manage money. And we showed him that, in his life, there is no guarantee that the cash values will ever be greater than what he paid in premium. And so for him, not needing a death benefit, is that the best thing for him to do? Wouldn't it be better just to manage his own money and make it grow like we teach in the Perpetual Wealth Code without worrying about building a legacy? He doesn't want the legacy. He has no need for it. And so that's why we always say you don't need a life insurance policy to practice the Perpetual Wealth Code. But why would you want to throw away the death benefit and the internal rate of returns? And of course, the internal rate of returns here then are not going to come in the guaranteed column for him. They're only going to come in the dividend column. And with dividends on his life, it only broke even somewhere around year 20, which is questionable whether his lifespan will last that long. So those are some things we have to look at. We want that to break even quick so that it benefits your life as well as the people you want to bless in the legacy.
So what you're hearing here is that one size doesn't fit all when it comes to life insurance.
Never does.
Never does. And so you have to look at the different situations. How do you know what all those situations are in advance? We don't expect you to. That's why we're here. You can give us a call at 702-660-7000. We're life insurance experts. We're figuring out how this is going to benefit you to build wealth in your life.
So when we talk about breaking even at Life Benefits, and we only speak for ourselves here because we're talking about when has the guaranteed cash value in a policy exceeded your cost basis or what you've paid for the policy. That's the break-even point, because at that point, your cash values continue to get bigger and bigger each year in comparison to the premiums you've paid. And your death benefit is, if you cash the policy out at that point, you would have more money than what you paid for it.
Yeah, so that totally blows, at that point, long term, this is the whole life designed this way is going to completely blow out of the water the term insurance premiums, because you never get any of those premiums back.
Now, we're always talking about the guaranteed side. Other agents will look at the dividend paying side, and that's not guaranteed. So we're always trying to work on the guarantees because we're trying to make sure that you know what you're getting into, and there's a promise, a contract that's going to make sure that you have your money back after a certain period of time.
But the dividends do matter.
Oh, absolutely.
That's one of the reasons that we're using companies that are mutual, that pay a dividend to their policyholders, because the dividend can add hugely to the compounding effect.
It sure
and
can.
Why shouldn't that be in your pocket instead of the money managers?
And one of the reasons we don't really focus on dividends in this office, because it's like the icing on the cake.
Sure.
If we can prove to anybody, and which we can, that the guarantees make it worthwhile, then when the dividends happen, then they're just making it that much better. But when we start to focus on the dividends and the returns that those are going to provide, not only can it leave you in question of whether the company is actually going to meet those dividends, or now we get into comparing what the dividend from one company is to another. And we've talked about that in another episode with the Vice President of Security Mutual.
In fact, I'll include the link to this to that in the resources for this podcast, so you can check that out.
And when you compare some companies' dividend, I was just doing this the other day to a very large company. Their dividend was 23% higher than the dividend that one of our companies would do in the same year, same premium, same age class, same medical classification.
Sure.
Okay. And yet our dividend bought way more paid up insurance than their dividend did.
More equity.
So when you're comparing dividends, it becomes another game.
Sure. You have to look at
you have to understand what's going on.
What actually ends up in your pocket at the end of the day. Yeah. It's been said before, it's not what you make, it's what you keep that matters.
It's what you keep that matters, yes.
That is so true. So with the with using the participating whole life insurance, we talk about the Perpetual Wealth Code a lot, and we separate the Perpetual Wealth Code from the life insurance. You want to speak a little bit about that. Why do we do that, and what does it mean for you?
Well, when I first started doing this almost 14 years ago, it was very important for me to realize that I was becoming my own money manager, because I had been in a position where I saw the money managers that were managing my money in my life were taking home more money than I was. And I didn't know how to combat that. And the truth of the matter is that we have to understand that your money is just as valuable as anybody else's money. So, for example, Americans lose 9% of their income annually to interest they pay to other people, and that's not including your mortgage.
That's a lot of money.
What if you could manage that 9% yourself and earn a 3% return on it, which is less than the average return that Americans are making today, which is 3.66. So if you could only do 3%, then over a course of a lifetime, you could have $500,000 easily for someone that makes $80,000 a year. I mean, just do the math. It's the first year you got $7,200, and the next year it's $85,000, and so on. It just continues to compound for you because now you're managing that interest. So First of all, the Perpetual Wealth Code is about you getting the interest on your own money that you would willingly or have to pay to somebody else for their money.
Mm-hmm.
And now, where is the best place to store that money while you use it? And you might as well be paid an extra little interest rate, even though it's not really an interest rate. It's just a guaranteed contract that you're going to get a return on that money, guaranteed, and the possibility of earning dividends on it while you're leveraging it to use someplace else.
I love it.
And that's why we use the life insurance policy.
There you go.
And at the beginning, the legacy might be less than what you need to protect your loved ones. And so it only makes sense that you also have a separate contract. Don't join it together with your participating whole life contract, but a separate contract of term insurance that can be converted to participating whole life insurance policies as your income grows because of the self-management of money.
Mm-hmm. So the life insurance is an ingredient in the money management process.
Absolutely.
It's not the, some people in the industry will promote the life insurance as the magic bullet. Never like to do that. It should be able to stand on its own 2 feet.
You've heard me say before that if selling dog food to people would get the same results as selling participating in life insurance, we'd be selling dog food. But it doesn't. Okay. Yes. The participating in life insurance has some very unique qualities that are available to you and me that aren't available, they just
no other financial
tool does that.
Certainly,
if
dog food would be your financial security, that's a pretty funny comparison, but it's true.
Or if someone was willing to line up and give you their money to manage, well, then fine, go ahead and manage their money, because that's where the money's made, is in managing the money. Mm-hmm. But you may not have people lining up to give you their money like Jeff Bezos, Warren Buffett, and all the people that are doing that. But that doesn't mean that you can't do the same thing they're doing on your own scale. It's just that you have to keep enough of the money that you're generating right now so that you can start managing that like they manage other people's money.
Certainly. And just because you start, everyone has to start somewhere. Jeff Bezos and Warren Buffett didn't start out by managing other people's money.
No.
And that's something good to keep in mind. Every big thing has a small beginning.
And what we have to understand, too, is that in the 2008 crash, the bankers did not lose their money. And that's rule number 1 of money management. Don't lose money. And the second rule is never forget rule number 1. And the bankers didn't lose their money. They lost investors' money, you and me. And now they're losing even more of our money because we are taxed to pay back the loss that they created. And we're still doing that. And we need to be in that position. And that's what the participating whole life insurance policy allows us to do, is to keep our money secure, safe, earning a return, while we get to leverage other people's money, the insurance company's money, and go out and do what we need to do to manage it to make more money.
There we go. So that's the Perpetual Wealth Code in a high-level overview. Of course, as you'll apply it in your life, that's going to be different for everyone. And so we're here to help you with that. Give us a call at 702-660-7000 and ask for a strategy session. We'll be happy to talk with you, go over your numbers, find out how could the Perpetual Wealth Code benefit you.
Well, you've heard the 20,000-foot overview of the Perpetual Wealth Code, as John said. But if you want the ground floor view, the individual view, that's what it takes to know whether the Perpetual Wealth Code is right for you. And if you're tired of paying interest to others, if you're tired of paying more taxes than what you think you should, if you're tired of losing money to volatility, if you're tired of seeing fees and penalties absorb more of your money than what you're making, then if you answered yes to any of those questions, the Perpetual Wealth could work for you. If you're diligent, disciplined, and willing to work hard, then the Perpetual Wealth can work for you.
Yeah. One more thing I want to mention here before we sign off for the week, that is we're lining up a couple special interviews for you. Not sure exactly when they're going to hit the podcast, but be sure to subscribe to the podcast. You can do that on our website, life-benefits.com. We'll keep you updated on those episodes. They should be coming out here within a few weeks. Couple exciting interviews coming right up.
There's one more question that we need to deal with here, John, and that is, if I have, let's say that I have $100,000 that I can make an investment with. Maybe I'm going to buy a rental property, and I know that that rental property is going to generate about 10 to 11% annually for me. Should I buy a life insurance policy with that $100,000 before I buy my real estate? Or should I, because I won't have all my $100,000 in cash value in year one, what is the best way to proceed when someone has been told that they need to buy the life insurance first before they make an investment?
That's a good point. If you don't know what opportunities are coming up and they might be years down the road, buy the life insurance, get it started, get it running toward it. If you know this opportunity is right here, right now, and like you said, in the first year, if you buy the premium, all that money is not going to be there the very first year to take advantage of that opportunity. Why would you tie up the money? Go ahead and get the opportunity, and then from the cash flow that opportunity creates, then fund the life insurance and get it going. Life insurance is going to be the long-term vehicle that gives you the compounding growth. Putting it in there all up front, borrowing it all out for an opportunity, that's not going to create the best outcome for you.
So how would you cover your liabilities in that situation, because you wouldn't have the whole life insurance?
In that case, that's a great place for term insurance. Short term, temporary.
Because short term is very inexpensive. It's not going to jump into your capital and keep you from making the investments that you see are good and available. It's not going to allow you to miss opportunities. And then it gives you the right to convert that to whole life later on, when the investment that you made generates enough capital to make that nice and comfortable and affordable.
Yes. And of course, there's always a balance, because time is everything. If you wait too long, if you think opportunities are always on the horizon and you never start the permanent life insurance, there is going to be a day when that term will run out.
Absolutely.
So it's all about balancing short-term opportunity with the long-term growth that you need to get sooner or later for your financial security.
Well, you are listening to Wealth Talks, where we talk about money, solutions, and other things that create wealth in your life. We'll be back here next week. God bless.